Okay, so last week we had started making some financial projections. And we talked a little bit about the nature of the projections, ways to go and look at making projections. And one process I want to kind of make sure you guys are, I want to reiterate is, as an analyst, my recommendation is to really focus on the mechanical first. In other words, I know it's important to do research and to really have your model honed. But if you're building a model for an associate or your boss, I've seen scenarios where an analyst would be doing days and days of research and not have too much to present. I think it's very important to find a balance in, okay, this is a fair assumption, quick assumption. Let me get the model together, and then I'm going to go back and tweak and work on the assumptions more once the model is done. That way, at least I have something to present. And you'll also find, as you dig into information for the further statements, the cash flow statement, the balance sheet, you'll realize, and you'll be doing research, and you'll learn a little bit more about the company that you're going to end up tweaking anyway. So what we had done was we had made a first cut assumptions using Yahoo Finance, which was it was an amalgamation of I think 41 to 46 Wall Street analysts. And they had assumed about a 35.5 aggregate growth rate in 2020, and then 18.3 in 2021. And we assumed in the beginning that drop is going to scale accordingly. You always assume in a 5 to 7 year model that the revenue growth is going to slowly scale down as the volume increases. So we had assumed about a 48% drop, and we carried that forward. Pretty aggressive, but we can always tweak and change that. For most of the other assumptions we assumed in the costs, it was a percentage of the revenue. So now here we are to Ebitda. So we have a nice projected Ebitda, and unfortunately, I'm going to quickly pull up Yahoo Finance. If you remember, this is where we got most of our assumptions. We went to Amazon. And again, if you are working at a bank, or ideally you'd actually get a research report. You'd actually get an equity research report. Here we go. That'd be a little bit more detailed. But we're going to go to analysis. And here we go. 46 analysts assumed about a 35.5% growth. And what we want to do is, really the idea is we want to build down our model and assume that the actual earnings per share is going to end up around what the analysts project, about $1. Whoops. Where's their year end 2020? I thought they had their year end 34. Here we go, 34.9. Okay, so that's the best, quickest first cut assumption. Side note on 5-year growth, oftentimes they would estimate it here. Here they have it for 36.35%. It's a little bit contradictory because 36.5% for the next 5 years, when they said that the next year was only 18%, was a little confusing to me. So I said, okay, well, listen, this is the year end. In a few months, we're going to get a little bit more information. Let's keep, this is where you kind of want to maybe not go too crazy with the research. Let's continue to build the model. We can go back and tweak. So the way the model process works from here is depreciation. Once you have Ebitda, depreciation and amortization typically comes from the depreciation schedule. we're going to build that out. Interest expense, interest income comes from the debt schedule. And we're going to build that out and link it back in. We could try our best to build around it. So what I'm going to do is I'm going to carry forward EBIT and EBITDA by copying right. And you guys know by now the copy right, which is highlighting EBIT, EBIT margin, holding down the shift key, tapping to the right. So we're highlighting the formulas that we want to be copied over and the area that we want to be populated. Let go, Control R. Copies all the formulas to the right. Okay. Now, we have this other income line item. And if you remember, we talked a little bit about other income quite a few classes ago when thinking about should other income be above or below EBIT. And that was a very important question and analysis because we wanted to determine if other income is considered operating for valuation purposes. If it is, it goes above EBIT. If it's not, it goes outside of EBIT. So you go back to, I think, the third class if you want a refresher on that. So if you recall, when figuring out whether that should be above or below EBIT, we found in the annual report on page 28 that these are basically related to securities, equity securities and warrants. And so no reason why then, or it's definitely understandable then why you see it negative, positive, negative. A lot of times when dealing with securities, you're buying and you're selling, or the value is increasing, declining, and you see these plus and minus swings. So when making projections, you want to think about the 7 methods that we spoke about last week. If you remember, when making projections, I said, obviously, if you really understand what the line item is, and you know what exactly is driving that line item, then you would know how to accurately make a projection. But most of the time, you don't really know. They don't give you all that information. So I've delineated that there are, no matter how a line item could be projected, there are 7 general high-level methods for projecting something. One, you would take an average of, let's say, the 3 years, past 3 years. It's a common method. 2, you would take the maximum of the 3 years. Maximum meaning it's a little bit of a conservative approach. I'm not sure what the expense is going to be next year. It's a little bit ambiguous how they got that number over the past few years. I'm going to take the highest number to build a conservative model, the maximum of the last 3 years. I like that method. 3 is the minimum. If you want to build an aggressive model, take the minimum, or the minimum in some scenarios might be conservative. If you're looking at cash flow, the minimum would be the most negative number. Cash out, that's conservative. 4, percentage growth. We do this with revenue. Look at the historical growth trends, project out forward. 5, percentage of operating. What I'm saying here is, we do this with most of the operating expenses. Let's look at each expense as a percentage of revenue. 6, we repeat the cycle. Meaning, if a line item is swinging negative to positive to negative to positive for a good reason, you're buying, you're selling, you're buying, you're selling, then repeat the cycle. It's a nice, accurate way to project the model. I'm blanking on what the 7th was. Come up with it in a second. Oh, the 7th is take the last year. The last year method. I see that often. Could be used. In other words, you're not really sure what the last 3 years is doing, and you can say in an unusual market environment, maybe 2018, 2019 isn't so indicative of 2020. So for 2021, let's just take 2020's metrics. taking the last year. And so the idea is this: if you really don't know, if the line item says other, and you can't really dig in or tell, how do I project this line item? Well, these are the ways to make projections. And then I can use logical reasoning to deduce and say, okay, well, I want a conservative model. So I'm not going to use the minimum. I'm looking for my strike through. Oops, here, Control 1. Sorry, I feel a little slow this morning. Strike through, there we go. Not gonna use the minimum. And you would narrow it down to likely 2 or 3 line items where then you'd have to make the decision. So for example, let's use this other income. Okay. Maximum is the most conservative, right? I could use the maximum of all 3 years, 183. That's the most conservative. That's the biggest expense, right? Let me keep that, maybe. I could take an average of the 3 years. Sure. Percent growth wouldn't make sense here because there are no growth trends. It's negative, it's positive, it's negative. There's no static growth trend here. So percent growth wouldn't apply here. Okay. Percent of operating also wouldn't apply here. In a line item that's swinging negative to positive to negative to positive, this would not give me consistent numbers when I look at this as a percentage of revenue. As you notice, a good way to determine if percentage of operating is a viable option is to calculate the metric and see if it's consistent. So for example, here, this is pretty consistent, 665, 667, 222. Percentage of revenue kind of is working. If I did it here, I'd get a negative percentage, a positive percentage, a negative percentage. It would not help me here. Strike that through. Okay. Repeating the cycle sounds really viable in this scenario. Negative to positive to negative to positive to negative to positive. Sounds viable. Or taking the last year, right? So now what I had done last week with the other expense line item, now I've narrowed down from what could be a completely ambiguous projection to 4 methods, of which I could take the maximum, which would be 183. Okay. I could take an average, which would give me a value of negative 122. I could take the last year's, which would be negative 203, or I can repeat the cycle, which would give me negative 346, positive 183, negative 203. Given the nature that other income, that we know a little information about this line, the little information is this is securities, which often have these swings. I think it's reasonable to deduce repeating the cycle is the way to go. But my point is to show you the logical process for how do you make reasonable projections before knowing what that line item really is. And usually what happens as an analyst is I'll make one estimate. As I continue to build the model, maybe I'll uncover a note or uncover something else that would reveal a little bit more information about what that line item is, and I can go back and tweak. So to repeat the cycle, I'm going to take 2020 equal to 2017, and I'm going to copy to the right to repeat these swings. Actually, I'm going to make 2020 equal to 2018. Okay, you see what I'm doing? So I go negative to positive to negative to positive, right? It's negative, positive, negative, positive, negative, positive, negative, positive, negative, positive. And oftentimes you'll see a scenario where you're really torn between 2 separate methods. For example, should this be repeat the cycle or should this be last year? And if you don't know, I'd highlight this. I'd build the model. I'd get my valuation. I'd get my stock price. And I would then look at the method, look what the value is, and then I'd change the method. And after changing the method, I would see, did this really make a difference? And I'll tell you, when you're looking at a company with $49 billion in Ebitda, this $183 million isn't going to make too much of a difference. but we're doing our best in making accurate projections. Interest expense and interest income will come from the debt schedule. And so we can copy over our metrics here: net interest expense, income before tax, EBIT margin. Okay. Income tax expense, a little tricky. When I pull up the annual report, and quick note, guys, I had sent you some additional information here, which is going to be helpful for our projections. The annual report, which is the first place to go, I had mentioned for some reason in the PDF, and somebody was helpful in letting me know why. There is I don't know if you want to call it a technical glitch, but you can't search for some reason in here. I found the 10K. I emailed you guys the 10K. The 10K is like the annual report. It's got a lot more detailed information, and you are able to do a Control F search in here. So I'm going to open the 10K, and I'm going to do a word search on taxes to look for tax information. And why I'm looking for taxes is because this was pretty unusual. The taxes were low, 20, then it dropped to 11, then climbed up to 17. What are the tax rates they're paying? Were they getting some crazy deductions? And there's a note in here that says they expect their tax rate to be 21% in 2020, okay? So let's use that. Let me see if I can find it for you. I think it was on page, I have the note in my final that I can dig in there for income taxes. Here we go. So we found the section income taxes. Okay, I don't want to spend too much time redoing research that I had already done, but there is a section where they explain their tax rates to be 21%. Okay, I believe it's around page 28. But this is what I would do. Quickly do a search, do some reading. Okay, looks like we might be, our tax rate, where did they say it? Okay, I don't want to spend too much valuable time, but it's 21%, okay? And if anybody sees anything different that we could, please let me know, and we can dig in differently. I might have gone to this, see item 8, part 2, note income taxes for additional information, okay? Then you went down. Let's see, I don't want to spend too much time, but it's good peace of mind to show you exactly where that comes from. And they don't, let's see if this takes me there. If it doesn't take me there quickly, then let's move on. Okay, it's not, well, okay, hold on. Let's see if we get to this note. All right, it doesn't, but it will eventually, okay? And they gave me a note of 21%. So I'm going to hard code in 21%. And to calculate my taxes, it is 21% of the EBT, not of revenue. And a lot of people look at percentage and they're used to doing percentage of revenue. This is a percentage of your bottom line. Copy to the right. Why this big jump from 2 to 10? Because we don't have these expenses filled in yet. This will get populated later. Once we build depreciation, we're going to link it into here. It's going to trickle down. Once we build our debt schedule, one of the final pieces, we'll link it into here. It's going to trickle down. Non-occurring events were 0. This was just shown to illustrate that that's where this, that this section is a necessary section. I'm going to copy everything to the right. And we have our net income. Okay. Income attributable to non-controlling interests. These are the investments that Amazon has that are greater than just stock investments, that are not controlling, meaning if they're controlling, they would actually own the business. So they're less than 50% interest. And these are also potentially, although Amazon doesn't have it, potentially any piece of non-controlling interest that another company might have in them. Amazon would have to give out a piece of its income. That's all calculated under net income. And you can see this is swinging for likely much the same reason that a stock investment would swing. The company's profitable, maybe it has some net losses, maybe it's profitable. So I'm going to repeat the cycle. Negative, positive, negative, positive. Okay. It's helpful, and I'm going to just mention this, and I might go back and do further research. It's helpful to go back when you're going to repeat the cycle. It's helpful to go back even further, to go back 5 years, 6 years, to see if it's truly negative, positive, negative, positive. Maybe it's negative, negative, positive, negative, negative, positive. So if you're doing repeat the cycle, it is helpful to go back a little bit further to get a little more information. Dividends paid. The company Amazon has not paid dividends since its inception in 1997. If you want to learn how dividends are calculated through, you can look at my other book on Amazon. So I'm going to copy everything to the right. Okay. And then we're down to earnings per share. But before we can figure out earnings per share, we need to know the most current number of shares. So shares, we need to project, so to speak, number of shares. So with shares, we don't really extrapolate projections like we do with percentage of revenue, things like that. The best way to project shares is to go to the most recent filing produced, regardless of if it's the filing of the reporting that we're modeling. So for example, we're modeling out 2019, so we pull out the 2019 report. Regardless of that, for 2020, I want to go to the most current filing. And so the most current filing out, I didn't check this weekend, but as of last week, was their third quarter report. And so I'd email you guys. I've been emailing you the third quarter report. Here's a third quarter report. And in the most current report, what you want to do is to get the most recent stock number. You want to go to the cover, because the cover of the report will actually give you, here it is, the value of shares as per the printing of the report. So in other words, even though this report is about September 31st, 2020, the report was printed almost a month later, October 21st. And on the print date, they update that stock number. So that's the most current reported value you can get, the cover of the latest report, which is 501-751-183. So let's use that number. Equals 501, period, because we're rounding to millions, 751-183, which is rounded to 502. Now, let's talk a little bit about diluted shares. The difference between basic and diluted shares, we spoke a little bit about when we first inputted these numbers, is the basic shares are the shares currently outstanding in the market. Reported on the annual report, there are 502 million Amazon shares out in the market. The diluted share number is almost, I think of it like a what-if scenario. Because as many of you know, there are other types of stocks out there. There are employee stock options. There is restricted stock. There are tradable stock options. These are all pieces of paper that are not yet common shares, but can become common shares under certain conditions. For employee stock options, they could become common shares if, let's say, after 5 or 10 years. For tradable stock options, these are pieces of paper contracts that say, well, you have the right to exercise this stock and convert it into common stock if the stock price is at a certain value. And in the example of stock options, there could very well be a lot of these contractual stock options that are in the money, meaning the stock price is is at a value where technically you can convert that contract into a common stock, but for whatever reason, that investor or the holder of that contract has not yet exercised it. Maybe he's waiting for the stock to go up further and make more money off the contract, or there's a lot of reasons why you might want to hold on your contract and not yet exercise it. So the diluted share number basically says, well, I understand there's 502 million common shares outstanding, but how many contracts are out there that can be exercised today? And if all those investors that are sitting on those contracts exercise today, now how many stock options would be out there? I'm sorry, now how much common stock would be out there? It's a very important number to understand for certain situations, such as, I think the easiest to understand is if you were to buy this company. We're not going to get into M&A in this course, but we do talk about M&A later. If you were to buy a company, the way you buy a company is you have to buy out all of the shareholders, to buy out 502 million shares. And if you were doing an analysis and saying, well, I got to figure out how much it's going to cost me to buy out all the shares, I got to consider all those stock options that have not yet been exercised, because it will very well be the case if an announcement comes out saying, hey, I'm buying out all Amazon shares, that all those investors sitting on those stock options are going to say, well, I'm going to convert those stock options now to common stock. It's my last chance. That's where I need to be responsible to calculate my diluted shares. So how do we calculate it? Well, what you have to do is you take the basic shares and you have to find all the diluted shares that are out there. How do you do it? A couple ways. One is you pull up the annual report, do a word search on options. Okay. Look for, there should be stock option tables that tell you how many options are out there in the market. Here you go. Okay, now they talk of stock options. Keep going. There's a table here, I know it. Here we go. Why is it not coming up? We go option. Stock option. There are stock, here we go. Nope, there are stock option tables that will tell you okay, well, to not waste time, it will be in the book, but there are tables that tell you how many stocks are open in the market. So one way of looking at this is by looking at the stock options table. The concern, though, is we're looking for a projected number, right? So if you even find a table in the 10K annual report, you want a more recent table. You want a more recent table of all the stock options outstanding up until the most recent, or up until today. So we can go to the Q3 report and look for options. You want to gather all the options information that you can get. Okay, I want to show you an example of one. What a shame. I'm sorry, guys. I definitely uncovered a couple, but the benefit is, and if anybody has my my Walmart book, it's definitely in there. Okay. But where I ended up getting the final number is back to their Q3 investor presentation. Investor presentation can be very powerful because in their investor presentation, they talked significantly about stock. They talked about sales projections. They talked about net income, which we're going to look at. Whoops. And they talked about their shares. Here we go. And they said, as of Q3, They had 502 million shares, matches what we have. 16 million stocks outstanding exercisable. So I'm going to throw in a 16 right there. Whoops. So I'm going to go 502 plus 16 is 518. Okay. And I always make a comment as per Q3 2020 investor presentation. So you can always document. Okay, but so again, going back to utilizing all your resources, first thing I'd look for a stock option table in the 10K. And so what was interesting, and I'm sorry I can't find it right now as we're speaking. Let me try to word search again. But what was interesting is the stock option table, as per the annual report, told me that there was 12 million options exercisable outstanding. So I started actually putting that in my model. Then as I was doing more research, I uncovered this investor presentation that gave me, and the investor presentation was as of Q3. So 9 months later, it gave me a 16 number, which was greater. So I said, okay, this number is a little bit more up to date. So I changed my 12 to 16. Again, this is an example of the thought process and the methodology. I first started with 12. As I started to build the model on the side to prepare for these courses, I updated the 12 to the 16. Your model, you keep tweaking as you get more and more information. And I updated my comment. What does this mean for earnings per share? Copy to the right. Okay. This is where you can get a good sanity check of your model projections. So what is the street? Yahoo Finance gives two valuable pieces of information. Okay, it gives revenue growth and it gives projected estimated EPS. Now they gave me 34.9. So whoa, why do I have 77? Well, big reason is I have some expenses in here that I haven't yet projected. And it's going to change. So what I want to do is I want to take a quick, just to see how this all falls in line for EPS, just to see if I'm in the ballpark area. I want to take a quick look at what would happen if I just took my depreciation expenses from last year and my interest expense and income from last year. Where would that put my EPS? 41.68. Much closer. 2020. Now, what's different here though is look at this growth. I am pretty sure that my depreciation is going to grow a little bit. So let me make a quick analysis just as a sanity check. What was the depreciation as a percentage of revenue? Just as a quick sanity check. 7.76%. Okay. If I take that 7.76%, and you can just watch, you don't have to follow me here, just quick, as a percentage of revenue, if my depreciation was 29 billion, which it should sort of come out to be, where are we at now? 30. What do they have here? 34. Okay. So my point is, between giving a quick look at my plugging in my expenses, I have an EPS of between 30 and 40, and the average on the street says 35, right smack in the middle. So I'm within the ballpark. So my sanity check is sound for now, and I'm going to take that out there because the next step is now what I'm going to do is I'm going to copy all of this going to the right. My income statement projections are done for now. There's a few holes in here. And the next step is now to go in and build the historical cash flow statement, look at the cash flow statement, project the cash flow statement as best we can, and then we start to build the supplementary schedules that connect the income statement with the cash flow statement. Working capital schedule, the depreciation schedule, and that all ties into the balance sheet. We'll build the projected balance sheet, and then we'll build the final model, the debt schedule. We'll value this business and we'll go and we'll tweak and hone in on our assumptions. That's the process from here. All right, guys. So next Monday, I'm going to send this out to you. Next Monday, we're going to look at the cash flow statement. We're going to dive into the cash flow statement. We're going to talk cash flow high level. Go back to the PowerPoint. We're going to take it from there. If anybody has questions on assumptions, anything like that, please feel free to email me anytime. Thank you, guys, and have a good week.